Good morning, everyone. Good afternoon, everyone. Good evening, everyone. Welcome to session 10 of MOOC 11, Regulatory and Tax Treatment. I know sometimes for a lot of people this may or may not sound like the single most exciting piece, but I think this piece is endlessly fascinating. It has absolutely a ton of interesting theory behind it, interesting practical implications. And it's something that everyone should be paying some attention to. So we have a few questions we can go through. Before I jump into them, I would note that there have been developments in the last week or so on the regulatory front, in that the Securities and Exchange Commission of the United States, the SEC, has released further commentary on this topic. Now, it's interesting because the commentary, while it was several years in the making, actually hasn't changed in substance the SEC position. And the SEC position is a general position that doesn't have to do with cryptocurrency or blockchains specifically or ICOs specifically. It is a general position about how the United States views securities offerings. And it's a position that is described as the Howey test. It came from a Supreme Court ruling. And like many US regulations, it's principles-based as opposed to being very detailed-oriented and very specific about what can or can't be done. And the principle is, when is something a security? And if it is a security, then the normal security regulation needs to apply. And if it's not a security, then these don't need to apply. Now, some of you might be asking, what does this mean? What applies if it is a security? And very broadly speaking, and I'm summarizing huge pieces of law and practice here, if you want to sell a security to the general public, you have to go through a relatively heavyweight set of requirements on disclosure, on financial statements, on governance, and so on. Imagine this as a first approximation. If you want to be a public company and you want to sell shares to the public, you have to have a detailed prospectus and annual reports and meet a variety of requirements that are meant for investor protection, right? So the general principle is, if someone wants to invest in your security, you don't have to guarantee, in fact, you should not guarantee that the price will go up, down, left, right, or in any other direction, but you do have to guarantee that you have given the correct information and accurate information and complete information and complete disclosure so that people can make accurate decisions about how much they want to pay or not pay for your security. And beyond the legal requirements, there is a whole series of case law and practical aspects that, in the United States in particular, there's a running joke that everything is a securities law violation. So if your company, I'll put it in this context. Let's say your company was doing something inappropriate. It was polluting beyond the permitted requirements. You might think that's not a securities law violation, that that's in fact just a pollution law violation. But if you were doing this as a public company in the United States and then were caught, you would almost certainly face a shareholder lawsuit. And the basis of that shareholder lawsuit would be along the following lines. The fact that you are polluting is a material and important thing you should have disclosed to your investors. and you didn't. And so it's also a securities law violation. And so the general thing to take away is once you're selling shares to the general public, then you have to be very careful, very complete, very detailed about what you disclose about your company. Now, obviously, not every company is a public company. Not everyone sells shares to the public. And so the question is, well, what's the lighter weight form of this? The lighter weight form of this is if you are selling to what are known as accredited investors, then you don't have to follow a lot of these requirements. And accredited investors are defined as either wealthy or knowledgeable investors, but in practice, the wealthy hurdle tends to dominate, that if you have a salary over this much, or assets over this much, or at least investable assets of this much, then it's okay. You are allowed to sell to these people. Now, there's another interesting theory here, right? Because the idea, again, is investor protection, and what they're in effect saying, if you're wealthy and you then invest in a investment instrument that doesn't seem to go very well, or it ends up being too risky, or you lose your money, well, you have, at that point, some cushion, some margin for error. You can take the risk. You can take the risk of having invested in something that doesn't work out. And that was the general idea. It's interesting because we've been in such a long and generally successful tech boom that some people make the opposite argument, like, oh, this is terrible. You're keeping people who don't have a lot of wealth from investing in opportunities where they could make a lot of money. It's like discriminatory against non-wealthy people. Now, what it was meant to be is protective against people that didn't have necessarily the resources or the capacity to take these types of risks. And whether this is good or bad, which one is more relevant, I'm not sure, but it's an interesting discussion. Third bucket that has emerged for small amounts of money are what are called crowdfunding laws, and they exist both in the United States and elsewhere. And these crowdfunding laws allow you to raise 1 or 2 or 5 million, generally not more than that. And with these crowdfunding laws, you can invest this money even if you're not an accredited investor, even if the company doesn't meet all of the criteria for a public company. Now, this is the context, right? Well, let's think about what we saw a couple years ago with ICOs. Were they raising a small amount of money that would fit into the crowdsourcing requirements? Definitely not. Like, they were raising 5 and 10 and 15 and 20 and 50 and 100 and 150 million dollars at a time. EOS raised 4 billion. So there's really no coverage from the topic of crowd funding legislation. Were they selling only to accredited investors? Again, clearly not, because if the way you're raising money is you're issuing a token on a public blockchain and you're issuing the token in exchange for Ethereum or Bitcoin or whatever it is you're issuing the token in exchange for, by definition, that's not a process that says, and I am first confirming with a bunch of signed documents that you meet this requirement, that requirement, the third requirement, and the fourth requirement, and the sixth requirement. So they weren't raising from accredited investors, they were raising from the general public. Well, if they were raising for the general public, were they meeting the requirements for registering their securities with the Securities and Exchange Commission and then fulfilling all those obligations? Well, definitely not. And arguably an impossible hurdle to meet, because if you're operating an ICO on a public blockchain, first of all, you could have investors from anywhere in the world. And it's not just sufficient to meet the SEC requirements. You might have to meet the UK requirements, the China requirements, the Egypt requirements, the Russia requirements. So you have this problem of jurisdiction, which is problematic. And then you have the problem of these are early stage startups that you would never consider in a normal environment have the capacity to meet the burden of public company requirements to be selling to the general public. So that's also a problem. And then you even have a third problem. And the third problem is, even if you wanted to do all that, it's unclear in some of these cases what it is you're reporting, right? Because to the degree that some of these entities are relatively decentralized, are you reporting about the token? Are you reporting about the company? Are you reporting about the ecosystem? It's confusing. You know, stocks and bonds, very broadly speaking, have been, it's well established what you should report, what's the entity that's reporting, what rights each of them have, and it's still complicated to get it right. If you're issuing a token on a blockchain that today is centralized and they're going to build a product, and then when you build a product, it's going to then be used for the product, and maybe it'll be decentralized or maybe it won't be, what exactly are you going to report? So the SEC resolved this in the simultaneously both most conservative way and simultaneously, I think, the only way they could have resolved it given the existing law in the United States, which is that we're going to apply the existing law. And the existing law says it does not matter what you call your security. You could call it a stock, you could call it a bond, you could call it a token, you could call it a hat. What you call it is irrelevant. We are going to look at the substance of what is this thing. And the substance is defined by the Howey test. And if it meets the requirements of the Howey test, whatever it is you said it is, doesn't matter. We're going to treat it like a security. And the Howey test has requirements like, are you relying on the efforts of others in a collective enterprise to generate profits for your instrument? And what's interesting is this can take you into very interesting territory where you wouldn't expect things to be securities. There's a very famous case where, and I'm trying to check when exactly, find exactly the date of this. Here we go. In 1967, Continental Marketing Corporation effectively had the following history. There was a time when people believed that raising beavers, the animal, for their fur was a viable and exciting business operation. That you have a beaver, and the beaver costs this much, and you have to feed them this much, and at the end of the day, you're going to sell the fur for this much, and it's a good return. You will make money. And you start off and say, okay, that's nice, and how are you going to implement this vision? I'm going to sell you a beaver, and you're going to have a beaver in your house, and you're going to feed them and care for them, and then sell their fur, and maybe some people will do that, but that's annoying, right? That's difficult. So eventually where these guys ended up was, well, we have a farm. We'll keep the beaver here. You'll buy the beaver, but we'll keep him here at our farm. We'll feed him, give them water, keep them from running away, and when the time comes, sell them for their fur, and then give you your appropriate return based on how much we sold the beaver from. The Securities and Exchange Commission sued and won that they were selling investment contracts, that they were not selling beavers. The company was like, I'm selling beavers. I said, no, you're selling a security. It is a common enterprise, and the buyer is relying on the efforts on others, and you have an expectation of profit, and so on and so on and so on. And there's a lot of details that aren't relevant, but the important point is something that looked like you're buying a beaver turned out to be a security under US law. And so with this type of thought process, well, many things are securities. And here's where the SEC came out and said, basically, the same standards apply. And by these standards, I believe almost every ICO that was done during the ICO boom will turn out, in retrospect, to be a security. And that's interesting both retrospectively, but it's also going to be interesting prospectively, because I think a lot of the models by which people ICO'd 1 or 2 years ago are not going to be viable in the United States for the foreseeable future. They even got into specifics. They said, let's say I, Antonis Polemitis, want to issue a token to purchase ham sandwiches here in Cyprus. It is ham sandwich token, ham sandwich coin, HSC, ham sandwich coin. And this token is exclusively for the purchase of ham sandwich, as in my ham sandwich ecosystem. And so I'm saying, look, it's a utility token. This is not an investment contract. This is a utility token. It's like a gift certificate. The SEC said, if we have this token and I issue it before I have built my company, my blockchain, my ham sandwich ecosystem, if at the time the person buys it, you cannot then turn around and use it to exchange it for a ham sandwich, it is at that point most likely a security. It might, in a later stage, convert to a utility token if and when the ham sandwich ecosystem comes into being, and the only practical use for these things is buying ham sandwiches and selling ham sandwiches and trading ham sandwiches and mortgaging ham sandwiches, then that might be okay. But at the time that it was sold, if there was no such entity, if there was no such ecosystem, then it is a security. This, I think, is, both clear. Hard to imagine anything else actually being done other than this, because for anything else, the law of the land, to speak in the United States, is the Howey test. So for something else to happen, someone would have to pass a different law and says, well, it's the Howey test, except in the case of, tokens, in which case it's this other test. And there is no such law. So it's not surprising that SEC came out with this guidance. But I do think it is along the lines of the most conservative view that one could reasonably believe could come out from existing interpretation of existing law. So we will have to see different models. It might be models that in the beginning are for accredited investors and then convert to tokens that can be sold to anyone later when the company is built or when the ecosystem is built, when they're more decentralized, and so on and so forth. It might not be that way, though, on day one. Now, what do I feel about this? Complicated. On one hand, I think they are not being unreasonable. They're not being at all unreasonable, right? You can't have a system that says, if you call it a bond it's a security. If you call it a variable annuity, it's a security. If you call it a Beaver contract, it's a security. But if you call the exact same thing a token, it's not a security, because that's silly. Like, why would the rules work that way, right? The problem that I still see is that there is something very interesting and magical in how ICOs worked, where people were collecting money or value or tokens simultaneously from around the world in greater and larger quantities. And even though a lot of those ICOs were scammy, intentionally or unintentionally, there's still something interesting about that, being able to access that type of crowdsourced capital. And it might be the case that it's hard to really do this correctly as a security in these decentralized ecosystems. So one potential model might be, and this is not today's law, it's tomorrow's, it's something that someone might do tomorrow, is to think about, is there a version of crowdfunding or crowdfunding law that could be expanded to capture some of the opportunities and approaches available with cryptocurrencies and blockchains? Because I think it's difficult to go downwards from securities law, because it's hard to say, where do you draw the line and say, oh, well, at this level, it's no longer a security and it's something else. Whereas I think it's easier to move upwards from crowdfunding, because it's already been established that up to a certain point, yeah, we know there's risk, but there's not that much money involved in aggregate. So let's just have a lighter set of requirements for crowdfunding than we would for a big public company. And so I think there might be room to expand that, develop that further, and move in that direction. And maybe we'll see some countries do some interesting things in that area. Okay. With that, let me go to some of the questions. The BIT license has an equivalent in Europe, e.g. Estonia. Right now, I see a need to regulate/allow exchange of security tokens. What could be the next steps for EU countries in this area? Well, the next steps is we're at the following phase in the EU, that many countries are working through this topic, and they're working, some of them have released guidance and or passed laws. Switzerland, Malta, Liechtenstein. Some of them, like Cyprus, are working on the legislation now. I'm part of that committee, so I can tell you it's being worked on now. And the standard view right now, which I think is going to be a moving target as we learn more, is the following. First of all, for things that are token-based, that there might be 3 ways to classify tokens. The first might be as securities tokens. The second might be as utility tokens. And the third might be as payment tokens. And I think a good way to think about that, a payment token is something like Bitcoin. It is highly decentralized. There's no one in charge. It's functioning something like a currency. And as a currency, you don't expect someone to write, if you want to go buy euros, you don't expect someone to write your prospectus and say, oh, you're at Travelex at the airport. Oh, Mr. Polemitis, I see you're getting 1,000 euros worth of foreign currency. Before you do that, please read this 163-page prospectus about the risks in the Eurozone, right? We don't have that expectation. And so, but payment tokens are rare. They need to be decentralized. And, Bitcoin is through the hurdle, probably Ethereum. And then after that, it gets questionable. Utility tokens are effectively gift certificates, right? Like they're saying, this is a token, you can use it to buy nights in hotels or ham sandwiches or dental care or to gamble or to whatever. And there, if that's all it's used for, if it's used to be an exchange for goods and services, well, arguably a good way to think about it is that it's like a gift certificate. And then there's the securities tokens, which we just spoke about. That's at the token level. Separately, a lot of people, a lot of countries are working through which businesses in this field need to be licensed. And there you look for parallels from the traditional financial services industry. Are you running an exchange? Well, if so, it might make sense for you to be licensed in a manner similar to someone who's running an exchange where you can sell shares of IBM or pork bellies or some other tradable commodity. Are you a broker? Maybe you need something like a broker's license. Are you a custodial wallet? Maybe you need something like a custodian's license. And so on. So this is different, but related to how you're going to treat the tokens themselves. This is how do you treat the service providers separately from how you treat the tokens. So this is how I think a lot of countries are looking at it. I think things will change over time as we learn more, but I think that's kind of state of the market from the regulatory perspective. Is regulating cryptocurrency like regulating the internet? Don't you think if Pakistan is trying to regulate cryptocurrency, they are actually trying to deregulate it? Wow, I am not totally sure I understand the question. This is like one of those Zen koans. If Pakistan is trying to regulate cryptocurrency, they're actually trying to deregulate it. I don't know how to answer that part. I'll answer the first part. Is regulating cryptocurrency like regulating the internet? Yes and no, and it's a little bit the same and a little bit different. You can regulate the internet, right? And many countries do. And many countries can put controls on the internet to enforce those regulations. If you want to run a firewall at the level of your country, because you have internet service providers, and ultimately those internet service providers have data centers, and ultimately those data centers connect to undersea cables or overland cables to go to other countries, you can find the points by which the internet comes in and out of your country and go to the people that own those points and say, you need to do this. And if you don't do this, I'll fine you, I'll put you in jail, I'll take your network operating center away from you, and so on. So the internet is, practically speaking, able to be regulated. Let's put it that way. To the degree that it's not, and in countries that it's not, or it's less regulated, is where there are countervailing legal protections. So one of the reasons the internet developed, I think, so well in the United States is the United States has very strong free speech protections, the so-called First Amendment, the First Amendment to the Constitution. And the First Amendment makes it very, very difficult for the government to come and say, you can't say X, and so in the United States. And since that's the case, a lot of things you can go ahead and do on the internet in the United States that you may or may not be able to do in other countries. Here, cryptocurrency, to the degree that people treat it as a financial topic, I think it will generally have less legal protection than speech. In other words, even in the United States, there is absolutely a culture and a history of regulating exchange of money. And so to the degree that this part is, again, just the exchange of money or securities or some other financial instrument, I don't think there will be any constitutional level problems to regulating cryptocurrency. And I think the same will apply in Pakistan or many other countries. And so until you have, so practically, I think it's doable. And it will stop being doable only if and when we have very well developed and internationally developed mesh networks where devices are communicating peer-to-peer with each other, not through centralized ISPs, and we have a ways to go before we get there. And then legally, I don't think it's likely you will run into any legal obstacles to regulating cryptocurrencies or ICOs or service providers in the space. In the near future, some private tokens will have sufficiently large ecosystems in developing countries. For example, Facebook, WhatsApp, Amazon, Skype, etc., could offer private money at the expense or not of small countries. Would there be a tax and regulation regime applicable to private tokens? I think, yes, some of these companies will offer private tokens. I further believe a country would have the right to regulate the usage of these private tokens. I even further believe that fully private tokens will be less regulated than partially public tokens. Because it's unclear, again, depends how they're being used, right? If they're fully in the system of one company, like let's say the University of Nicosia issued a token that you could use to take courses at the University of Nicosia. That's all you could do with it. Arguably, it's a gift certificate. Arguably, no financial authority should care. On the other hand, if Facebook generates a token, and that token you can use to buy goods and services from 10 million merchants around the world, and you can convert cash into that token and that token into cash, and you, a consumer, can convert your US dollars or your Naira or your euros into Facebook coin, and you can send Facebook coin to a merchant on Facebook, and then the merchant can take Facebook coin and convert it into dollars and use it to pay his or her rent. Well, yeah, you're a financial services business, you're a money transmitter, you're going to end up, I think, being regulated just like a cryptocurrency exchange, right? Like part of how people have approached the question of, is it legitimately hard, and I think it is, for a company, for a country to regulate Bitcoin itself at the protocol level, which, I mean, it is. You'd have to kind of shut down the whole system to block it. What's turned out to be much easier to do is to regulate them at the point where they interface with your financial system. So if you want to buy Bitcoins and you live in the United States, you'll probably buy them from Coinbase or something like Coinbase. If you live in Europe, from Bitstamp or something like Bitstamp. Well, okay, you need to get money into Bitstamp. And how are you going to get money into Bitstamp? You're probably going to send them a wire transfer. And where are you going to go to send them a wire transfer? From your bank. And from your bank to where? To their bank. Well, both your bank and their bank are fully within the existing financial system. And at that point, they are already covered by existing anti-money laundering requirements. And at that point, it's very straightforward to just apply the existing rules. So to the degree that a Facebook generates its own token, for that token to be practically useful, ultimately you'll need to be able to spend it outside the Facebook ecosystem. If you have to spend it outside the Facebook ecosystem, you have to have an exchange. You have to be able ultimately to get dollars or euros back out of Facebook. If you're going to do that, it's going to run into the banking system. Once it runs into the banking system, I believe you will have all the same requirements that you would normally have for anti-money laundering and know your customer requirements. And I wouldn't expect anything too different from whatever the normal policy is in your jurisdiction. I suspect it will take longer for these requirements to be fully fledged out in developing countries, but I think it will happen because most countries do have some form of KYC or MAL requirements already in place. You can buy crypto with fiat. This money fiat returns to the banking system in the account of the person who sold the crypto. The regulations to the financial system can be adapted and to the cryptographic system to give security to the ecosystem. Yeah, I don't think it gives security to the cryptographic tokens themselves. Those run on their own security that is mathematically based. What I think it does do is provide an opportunity for people to apply the regular, normal, standard AML KYC requirements as we were just discussing a second ago. So I think that's what you're going to see on this interface between the fiat system, the traditional banking system, and the part that is the crypto system. Okay, so these were the questions I had up front. I think I might have a couple of questions online. Let me check. What are your views on security token offerings? Now, we had discussed that in general, tokens that are securities are, I think, is going to be the treatment in a lot of jurisdictions and certainly the treatment in the United States. And I think it's going to make it difficult for projects of the type of the early stage speculative type that we saw last year being coming to market, for those to come to market again. There's also another bucket which sounds similar, but it's a little different, that it's called tokenized securities. So this is something that would be a security or an asset in the real world. And someone is then taking that and tokenizing it and making it tradable as a token. So let's say it's an apartment building. And instead of, putting a company around the apartment building and selling shares in the company, or people buying directly in the property itself through the land registry, this would be a model where people would create a token that represents building X, and people could buy or sell different quantities or fractions of quantities of that token. I do think this will happen. I think there are significant asset classes for sure real estate that are still insufficiently financialized this way. And to the degree that they're financialized in relatively heavy structures like real estate investment trusts. And I believe there's an opportunity to move to somewhat lighter weight structures like tokens. And here's where there would be a counter argument by some people in the existing financial community. Oh, we have methods to do this, right? You can put them in a REIT, and you can put them in a REIT and then trade shares in that REIT or units in that REIT among yourselves, and in many cases on public exchanges. And while that's true, I think there are practical minimums, minimum size below which it doesn't practically work. Like it's probably 100 million worth of assets. Oh, okay. If you have a $25 million hotel, is it implausible that some people might want some easy way to buy or sell shares in that hotel that isn't put it in a company and take the company public, and isn't put it in a real estate investment trust and take that public? Yeah, I think there's an opportunity there. And it's interesting because technically speaking, those aren't different than tokens that are treated as securities because the token's a security. But I think practically speaking, it is a completely different usage case. And I don't think it's been well addressed by any country yet. And so what do I mean it's a different usage case? What people had in mind in the ICO securities tokens is, I'm starting this new exciting blockchain-y thing, and I'm selling tokens in this new thing. And if you buy this token, that will appreciate if my new thing works well. Well, it's kind of like you've bought equity in a venture capital startup or something. It feels like early stage venture capital. The other one could have any number, and it will have this type of risk reward profile of early stage venture capital. The other type could have any risk reward profile at all. It could be a company. It could be a building. It could be a group of buildings. It could be a house. It could be a hotel. It could be car loans. It could be cars. It could be boats. It could be anything. And as you have these different assets, you will see a separation, because today they're blended together, of like, oh, it's tokens, and tokens represent this like wild and crazy magic internet money technology stuff. I think we're going to see tokens, and the tokens are going to be the tokens, and they're going to represent real world assets. And those real world assets may have any number of characteristics that are very different one from another. And generally, as financial markets can get more granular, they do get more granular. As they can financialize more assets, they tend to do so. And so it is different, I believe. I believe it is different to say, I have invested in a hotel REIT, and in that hotel REIT, some manager is picking the hotels. Versus, I can say, you know, I want 1/10,000th of this hotel, and I want to be 1/5,000th of this other hotel, and I want to be short 1/3,000th of this hotel. And in fact, I mean, I'm getting ahead of myself, but imagine, oh, I'm actually interested in the suites of this hotel on the 5th floor and higher, but not in the economics of the other ones. I don't know if that's practically possible to separate, but theoretically it could be. And now you start building all of these much more complex portfolios, much more, you can build your own synthetic index of hotel performance, and you could program these things, and you could have high frequency trading in these things, and you could construct much more granular and interesting portfolios. Now, I don't know if there's going to be an advantage of this or not, but generally, the history of financial services is if you can find a way to bring new financial products to market, people bring them to market. And they bring them to market because it's a way to get in a new line of business if you're a financial services company. And so if it can be done, it probably will be done. And this one strikes me as it can be done. I don't see any reason why it couldn't be done. And then this describes a world of, so one of the debates that you sometimes see is in the online crypto world is, well, how many blockchains are there going to be? Right? Like, and here is on one end of the spectrum. on one end of the spectrum, you have, well, it's going to be Bitcoin. And on the other end of the spectrum, there's going to be like altcoins, lots of them. And then there's other people that, oh, there's going to be millions of tokens, millions. And there's very smart people that are saying like, oh, it's really going to consolidate around Bitcoin. And there's very smart people that say it's going to be millions of tokens. And those are very different views. And so then the question is, how can both of those be true? Like, who's wrong? And I think it's because they're talking about different things. I believe blockchains that operate sort of like a currency or a commodity, sort of like a dollar or a bar of gold or something that is a generic store of value or medium of exchange or unit of account, it doesn't seem logical that there are going to be millions of these, right? Like, that sounds difficult. Because how, practically speaking, is there going to be the global cognitive capacity to think about millions of these, right? We don't have millions of currencies. We've never had millions of currencies. We don't have millions of stores of value. We've never had millions of stores of value. And I'm not really sure what the advantage would be. We'd get lost if we had 50, let alone millions. On the other hand, if you imagine a world where a hotel, an individual hotel, could be tokenized, or even subparts of the hotel. I'll tell you one of the more interesting statistics I ever heard in my life. It's the Hard Rock Hotel in Las Vegas has a pool, and they ran a famous pool party. And that pool party ran on Sunday mornings, and it was called Rehab. And that pool party that ran on Sunday mornings, I believe, generated 10 million of EBITDA. It's a measure of profit, 10 million of profit per year. I don't know. Could you sell a token whose value was rehab? How are the economics of that pool party? 10 million a year is a decent sized middle market company all by itself, and it was just a pool party. So you could have a token for a hotel, or you could have a token for the residences in a hotel and the rooms in the hotel and the pool party in the hotel. I'm not saying whether this is or isn't a bad idea, but conceivably you could, right? And in that world, yes, then you could imagine millions of tokens. So I think the world of millions of tokens is a world where we start tokenizing real world assets, not a world where we are tokenized, where we have millions of purely virtual assets, virtual blockchains that for some reason we need millions of them. So I kind of believe both ends of the spectrum, that the number of blockchains we're going to use for cross-asset settlement, let's call it, will be a relatively small number. I don't know if that number is 1 or 5 or 10 or even 20, but it's not going to be 2,000. If I have to guess, it's not going to be 2,000. On the other hand, I could imagine many real-world assets getting tokenized. And there, once you get going, there's no obvious place where you're going to end, right? As these get more developed and more liquid and more standardized how you do them, it could be a way to provide more liquidity to illiquid asset classes in ways that don't exist today, right? It could be, and there's lots of complications. How do you exercise control over these things? What rights do token holders have? I don't know, right? We don't know yet. But it seems plausible that these things will eventually happen. Okay, we have about 5 minutes, so I think I'll maybe do one more question. What is the scope and regulatory approach on airdrops/bounties offered by ICOs? How can they be considered as a payment or gift for providing our data or doing social marketing for them? Yeah, so this is an interesting question, which is, I'd put forks in this bucket too. Like, if you get a fork or an airdrop, something where You get something without you doing anything for it. Well, what do you do with that? Right? Like, is that a... And let's take a fork because it's almost the easiest way to think about it. Day X, I own Bitcoin. Day Y, the next day, X plus 1, there's a fork, and I still own 1 Bitcoin, and I apparently own 1 Bitcoin Cash as well. Okay. Now what? What did I receive? Is it taxable? Is this a dividend from Bitcoin? Not really, I don't think. Is it income from Bitcoin? Also not really, I think. Is it a gift to me? Maybe closer in essence, though it sounds strange, right? It sounds quite strange. And the IRS hasn't fully come out to say their view on this. There's people that say, oh yeah, you have to treat it as it's taxable. That seems very problematic, right? Because you didn't ask for this. You might never claim it. You might not know how to claim it. You might be, because then if it's taxable, at what price is it taxed, right? Like, let's say you're on your round the world tour. And someday, through no fault of your own, someone forks Bitcoin, and on the day of the fork, Bitcoin Hyper Platinum Plus exists. And now I own one of these. And on day one, for whatever reason, it trades at $1,000. And anyway, I'm minding my own business. I'm on safari in Africa. I'm exploring my self-actualization potential in the Himalayan mountains. I come back 6 months later, and Bitcoin Super Hyper Platinum X is now 10 cents. At no point during this exercise have I even claimed my Bitcoin Hyper Platinum X, let alone sold it, let alone realized any gains from it. It would be very strange to me to someone say, oh, you had taxable income of $1,000 because at some very brief moment in time, you could have theoretically, if you knew about it, and if you claimed your coin, and if any exchange was trading it, and if there was liquidity on the exchange, and if you had sold it, you could have gotten $1,000. So I think you've got to treat it as something that is ignored until you sell it. And if you then sell your Bitcoin Super Platinum X, you then recognize a capital gain and you say your cost basis is zero because it did just kind of come out of thin air. One day you were minding your own business, and the next day you have something that later turned out to be valuable. And so to me, that's the most correct framework to think about here, that it's sort of like a gift, oddly enough, that you don't have any tax at the time that you've received it. And then if you sell it and you have a gain, you pay tax on the gain, and the gain is calculated as the difference between what you paid for it, well, in this case, zero, and what you received, well, whatever it is you sold. So now I know I was talking about forks, not airdrops, but I sort of think airdrops have to be looked at in that light as well. That you have to ultimately, a general principle to have a realization, you have to sell, you have to take action, you got to convert it into something. So I think a sensible approach would be that principle holds, that you have to sell and trigger an event, as someone is saying in the comments. And in the meantime, and then you go back and say, oh yeah, you don't have any basis in this. You have, this whole thing is a profit to you. It's a gain to you. You didn't have to spend any money for it. That sounds like a potentially sensible approach. Okay, everyone. Thank you very much for participating. Thank you for your questions. I encourage you to stay on top of these topics for multiple reasons. A, they're extraordinarily interesting, in my opinion. and B, they have huge impacts on what actually is going to happen in the cryptocurrency or blockchain or ICO world. And it's a good way for people to have an informed view on what might practically be possible versus what might just be a little bit of magical thinking. So thank you very much, all. We will see you again on Friday, and have a great day.